The Spider S&P 500 ETF put credit spread strategy is a powerful options trading strategy that allows traders to generate income while managing risk effectively. This strategy involves selling a put option and simultaneously buying a lower strike put option, creating a credit spread. It is particularly popular among traders who seek steady returns and defined risk profiles. A put credit spread, also known as a bull put spread, is a type of vertical spread where you sell a higher strike put and buy a lower strike put of the same expiration date. The net effect is a credit received, which represents the maximum profit potential. Sell a put option, also known as a short put. This generates a credit as the seller collects a premium. Buy a put option, also known as a long put. This limits the downside risk in case the stock price drops significantly. Net credit received. The difference in premium between the short put and the long put represents the maximum potential profit. Maximum risk. The difference in strike prices minus the credit received is the max risk. For example, if SPY is trading at $500, sell the $495 put for $3, buy the $490 put for $1.50. Net credit received $1.50 per contract, which is $150 per contract pair. SPY is one of the most liquid and actively traded ETFs tracking the S&P 500 index. There are several reasons why traders use this strategy with SPY. High liquidity, tight bid-ask spreads, and high trading volume reduce slippage. Defined risk and reward. The max loss is capped, making it ideal for risk-averse traders. Consistent income generation. It works well in neutral to bullish market conditions. Theta, or time decay, works in your favor. Since short options lose value over time, traders benefit from this decay. Hedge against market downturns. When combined with other strategies, put credit spreads can be used to balance overall portfolio risk. Choosing the right strikes and expiration is key to optimizing returns and managing risk. Factors to consider. Delta. Many traders sell puts with a delta between 0.20 and 0.30. Meaning there is a 20 to 30% chance of expiring in the money. Time to expiration, 7 to 45 days until expiration is common. Shorter expirations decay faster, while longer expirations allow more flexibility. Market conditions. If the market is in an uptrend, traders may choose closer strike prices. If volatility is high, wider spreads may be preferred. Deciding the right moment to enter a SPY put credit spread is crucial for maximizing profitability. Traders should consider using various tools and indicators to make informed decisions. Trend analysis. Use moving averages such as the 50-day and 200-day moving averages to identify a bullish or neutral trend. Enter spreads when SPY is in an uptrend or trading in a strong support zone. Support and resistance levels. Identify key support levels where SPY has historically bounced. Placing spreads near strong support levels increases the probability of success. Implied volatility. Higher implied volatility increases option premiums, allowing for higher credit received. Aim to enter spreads when implied volatility is elevated but not excessively high, reducing the risk of a volatility crush. RSI or Relative Strength Index. If RSI is below 30, SPY may be oversold, making it a riskier time to enter. Ideal entries occur when RSI is between 40 and 60, indicating a stable or bullish market. Market sentiment and news. Consider economic reports such as FOMC meetings and CPI data that could impact SPY. Avoid opening trades before major market-moving events to mitigate unexpected volatility. By combining these indicators, traders can optimize their entry points and improve their probability of profit. To execute a put credit spread, a trader needs sufficient capital to cover the maximum possible loss. This is determined by the difference in strike prices minus the net credit received. Margin requirement calculation. The margin requirement for a put credit spread is calculated as follows. Margin required equals the strike price of the short put minus the strike price of the long put multiplied by 100 minus the net credit received. Example. Sell the $495 put for $3. Buy the $490 put for $1.50. Net credit received, $1.50 per contract, which is $150 per contract pair. Spread width, $5, which is 495 minus 490, multiplied by 100 equals $500 max risk. Capital requirement, $500 minus $150 equals $350 per contract pair. Thus, a trader needs $350 per contract pair in their account to place this trade. Let's assume today is March 1st, 2024, and SPY is trading at $500. You expect SPY to stay above $495 over the next 2 weeks. Trade setup. Sell one SPY March 15th $495 put for $3. Buy one SPY March 15th $490 put for $1.50. Net credit received, $1.50 per contract, which is $150 per contract pair. Scenario 1. SPY closes above $495 at expiration. Both the $495 short put and the $490 long put expire worthless. You keep the full premium received, $150 per contract pair. Total profit, $150, which is 100% of the credit received. Scenario 2. SPY closes at $493 at expiration. The $495 short put is in the money and will be worth $2. The $490 long put is out of the money and expires worthless. Loss on the short put. $2 times 100 equals $200. Net loss is $200 minus the $150 credit received, which equals $50. Scenario 3. SPY closes at $490 at expiration. The $495 short put is worth $5, and the $490 long put is worth $0. The loss on the short put is $500. With the credit received being $150, the total loss comes out to $500 minus $150, which equals $350. Scenario 4. SPY closes below $490 at expiration. The $495 short put is worth $5, and the $490 long put is worth $0. Since both options are exercised, the spread reaches its maximum loss of $500 per contract pair. After subtracting the initial credit received, the net maximum loss is $350. The break-even point is calculated as $495, which is the short put strike, minus $1.50. Which is the net credit received. This equals $493.50. If SPY closes above $493.50, the trade remains profitable. These scenarios highlight the risk-reward profile of the SPY put credit spread, showing how traders can make informed decisions when entering these trades. Risk management is crucial when trading SPY put credit spreads. Here are key techniques to minimize potential losses. Position sizing. Never risk more than a small percentage of your total portfolio on a single trade. Many traders limit exposure to 1 to 3% of their account balance. Setting predefined loss limits is crucial for closing a spread early if the trade moves against you. Some traders choose to exit when they reach 50 to 75% of the maximum loss, to preserve capital. If SPY moves against you, rolling to a later expiration can help recover losses. This will be explained further in the next section. Traders may open an opposing call credit spread to create an iron condor, which helps balance risk. Additionally, buying SPY shares or call options can also offset potential losses. By implementing these risk management strategies, traders can enhance their ability to sustain profits and reduce drawdowns. If SPY moves against your put credit spread and approaches or breaches the short put strike, rolling the position can help manage risk and potentially recover losses. How to roll a put credit spread. Close the current spread. Buy back the short put and sell the long put to exit the existing spread. Establish a new spread with later expiration. Sell a new put credit spread at a lower strike price and extend the expiration. This collects additional credit and gives SPY more time to move favorably. Adjust strike prices if necessary. If SPY's trend remains bearish, consider widening the spread or moving to a lower strike range. Let's go through an example of rolling a losing SPY put credit spread. Imagine you have an original trade where you sell the SPY $495 put for $3 and buy the SPY $490 put for $1.50. This gives you a net credit of $1.50. Now suppose SPY drops to $490 with 7 days left until expiration. In this scenario, the $495 put is now deep in the money, and the position is at its maximum loss potential. Rolling strategy. Buy back the original spread. Open a new spread at lower strikes with a later expiration. For example, sell a $485 put and buy a $480 put, expiring in 3 weeks. Collect additional credit to offset previous losses. This approach helps manage losses while keeping capital at work for a potential market recovery. SPY put credit spreads are an excellent tool for traders looking to generate consistent income while maintaining a controlled risk profile. By carefully selecting strike prices, monitoring market conditions, and employing risk management techniques, including rolling positions when necessary, traders can optimize their chances of success. Whether you're a beginner or an experienced options trader, mastering SPY credit spreads can be a valuable addition to your trading arsenal. As with any strategy, practice in a paper trading environment before deploying real capital.